All right, let's do it again. This time I want to fix this bit, meaning I don't want to reverse the sales to the sales account, but use, once again, sales returns and allowances, a contra income account. So this time let's do an invoice and then the receive payment to do the full process. I'm going to do an invoice, and this will be for customer numero dos, customer 2. Customer 2, okay, save it. Why can't you come up with a unique name? That's lame. Can't you make it interesting? Customer 2? Customer 2, yeah, customer 2, okay. Whatever, unique name. Inventory item 1. This is gonna be, all right, so there it is. So what's this going to do? It's an invoice. It's going to increase accounts receivable by 108. The other side's going to go to sales for $100. Difference $8 in sales tax payable, and the inventory is going to go down by the $70 driven by the item. Cost of goods sold is going to go up by the $70. Net impact on net income 100 minus cost of goods 70 is 30. And the subledger for customer number 2, accounts receivable, is going to go up, and the subledger for inventory is going to go down, tracking it not only by dollar amount, but also by unit. Let's save it and close it and just double check it. Balance sheet, run it to refresh it. This time we put that into the A to the R, accounts receivable. And so there it is on the 108. Let's go back. The other side's on the P&L, profit and loss. 100 and only 100 over here because we don't include the sales tax. Back to the balance sheet. Sales tax portions in the board of equalization. $8. Those people that just take the money and don't even buy water for the fires that we know are going to happen. They hire people based on craziness. Can you carry a hose? That's how you should be hiring people. Do you have the strength to hold a hose that's shooting water out of it? That's what I'd like to. Anyways, here's the cost, $70. And then we're going to go back to the first tab, and we're going to say that inventory is going down by the $70. Let's go back, and in the subledger, running the subledger, we can see that the units of inventory are down to 9. So now we're at the 122625. Let's go back to the balance sheet. Inventory 122625. Let's go to the first tab, and we're going to go into the sales on the left-hand side. Once again, into the customers. We'll go down into customer numero dos, customer 2. So we have the customer here now. If they return the merchandise before we receive the money, we might issue a credit memo. But let's say no. Let's say that they're going to pay us the money now. So we're going to say we get a receive payment from customer numero dos, and we're going to say that this happened on let's just say it's a cash payment. We're going to put it directly into the checking account. Once again, $108. This is a receive payment. What's it going to do? It's going to decrease the accounts receivable. The other side's going into the checking for that invoice, connecting it to the invoice. Let's go ahead and save it and close it. And there it is. So we look at the detail here. So we can see now the payment is closed, and we can see the invoice is closed. They've already paid us. If we go to the balance sheet, we can run it to refresh it. We can go into that checking account. We can see the checking account went up by the payment, 108. We can go back, and we can see that the other side is the A to the R, the accounts to the receivable, the Pirates account, the R account. All right, the payment is there. Back to the first tab. Now they come in and they say, we want to return the merchandise. And it's like, dude, what do you mean, man? It works fine. And they're like, we'll sue you. We live in California. We can sue you for anything, and you gotta pay us. And they're like, okay, we'll just pay you then. Whatever. I'm moving. It's ridiculous. Okay. So now we're gonna say, okay, whatever. We need to pay these people because they broke our merchandise and now they want their money. So we're gonna, okay, whatever, dude. don't even know how you broke it. You must have hit it with a sledgehammer. Thing's been crafted with skill that's beyond anyway. We're going to do a refund receipt. Now, we could issue a credit memo now, but that would create a negative receivable. We're like, dude, we're better just pay this person off. They're crazy. So we're going to say, we're just going to give them a refund the receipt. Hopefully they go away. And so this is going to be customer number 2. And so we're going to say this happened on the 3rd. And let's say same kind of thing here. So this was inventory item number 1. But now what we want to do is we want to make it so it doesn't go to decrease revenue, but instead the allowance for doubtful accounts. So I'm going to make another item just called allowance for doubtful accounts. This is the tricky, this is where the magic happens. This is the tricky move, the sleight of hand that we're going to be putting into play here. This is where it happens. I'm going to make it a service item, and then I'm going to say that it's going to be just called allowance for doubtful accounts, let's say. And I'm not going to put a dollar amount because I'll just populate it myself. But if it's going to the inventory, maybe I want it to go to a new account, which is going to be returns and allowances. So I'm going to add the account on the fly as we go. I'm sitting on a fly as the wings are flapping, and I'm adding the account because I'm adding it on the fly. So we're going to say this is going to be what kind of account? It's going to be an income type of account, even though it's going to act like an expense. In other words, and I'm just gonna say service fee, whatever. I'm not too worried about that detail type. So allowance for doubtful accounts, I think that's good. Let's go ahead and save it and close it. I think that's what we want. Do I want taxes? Let's just take the taxes off and I can apply them when necessary. So I'm gonna say no taxes, and then I'll just be able to check it off when I need it. And so we'll save it. And so there it is. So what I'm gonna do is I'm gonna put the $100 down here instead of up here, but I will apply the tax out because we do need it, so that $8 will be calculating. So you might say, well, why would you do that? What's the difference? Well, this will record the same thing, but it'll record the revenue side to allowance for doubtful accounts instead of decreasing the revenue, and it will still record the return of the inventory. Now, again, if this person hit it with a sledgehammer and they still return it, they're like, oh, it broke somehow, dude. I don't know what happened. We're like, okay, then maybe we don't want this top bit at all. We might trash it because our inventory is not going back up, in which case we might just use this second line item. But if we have to increase the inventory, then we're going to be up here. So our policy is we increase the inventory and then we determine if it's no good, and then we'll write it off afterwards, we're going to imagine. So let's save it and close it. And select the account for this transactions. I didn't select the account. Refund form. Let's say it's checking. And I'm going to delete the number, imagining it's an electronic transfer. All right, let's try it again. Otra vez. Try it again if you could. Refund receipt saved. Okay. I thought I said save and close. You saved it, but you didn't close it. Follow the directions, QuickBooks. QuickBooks is getting slow. I'm going to call you slow books if you don't get your crap together, man. What do you need to move your central office out of California. I could see you're slowing down already. You need to do like SpaceX. You got to get out of here. This place is putting down the regulations. Anyway, so we're going to say what happened then. We're going to say if I go into let's run this thing and go into the checking account. And then now we can see that the refund happened, 108. The other side is going to go to the profit and loss, running it, the P and the L. This time, this is where the key is. This time, we didn't put it into income, but the refund went into donde. Oh, here it is up top because it starts with an A. So it's in income up top. Now, if I had account numbers, I can more easily, put it somewhere else, or I might make it a sub account of sales, returns, and allowances. But the point is that revenue only goes one direction and is up, and then this one is going to act like an expense, but it's in the revenue section to make like a net revenue account. All right, we've seen all the rest of it, so that's basically, I won't go through each of the other ones. Let's go to the first tab here. but now we can see this nice trail of what happened for this particular customer. And so, and that's going to be the point. Now, I just want to point out one more time that there is a scenario where you might say, hey, look, instead of having an invoice, maybe I give them a credit memo to result in a negative amount here, so that we can say, we'll allow you to maybe buy something later and apply the credit to a future purchase. So we might talk more about that later. But when you have that happening, you have this question of, well, if I have a negative receivable and I expect them to actually follow through with it, then maybe it should be a liability instead of a negative receivable. But if I had a liability, like with unearned revenue, the problem is I don't have a subledger that ties out to the liability account for customers, because the customer subledger is accounts receivable. So typically from an internal bookkeeping side, it works great to have like a negative receivable, because then I can see it right here. And if they make a sale in the future, I could go ahead and apply out that credit to a future invoice, and that would be fine. That would be fine to do. So just something to keep in mind.